In this video, I'm going to show you the best way to estimate a company's future cash flows so that when you do your discounted cash flows calculation and you're valuing companies, you're going to get a lot more accurate results, and in turn, your valuations are going to be much better and you're going to be able to make better stock investing decisions. Also, don't forget to stay to the end because I'm going to show you an especially cool way of doing this, which I recently learned about, which I think is incredible and very cool, so you're going to love that too. Alright, so here I am inside Guru Focus, which is the stock screener that I use, but everything we're going to be looking at here is also going to be available totally free through Morningstar, and I'll show you what that looks like quickly right now. If you go to the key ratios tab, you can pull up basically most of what we're going to be looking at in Guru Focus. But nonetheless, I'll give you a quick little tour. So Guru Focus has basically a snapshot of any stock that you want to look at. So here's Facebook's snapshot. These charts can be helpful for visualizing it. A bunch of important valuation ratios shown here, so you can get a good at-a-glance look. Things like dividend and buybacks show up in this section here, and then scrolling down a little bit further, whatever company you're looking at, there's going to be a description for that company right here, so that's obviously helpful too when you're screening through a whole bunch of different companies. But nonetheless, we're going to go over to the 30-year financials tab, and we're talking about growth rates in this video. So one thing that Guru Focus does automatically is it gives you growth rates. You can see right here, growth rates for revenue, EBITDA, operating income, earnings per share, free cash flow, book value growth. So the website does give you a lot of these numbers just automatically, but that's obviously not the extent of this video. I want to show you how to estimate future growth rates. So that's what we're going to show you now. So typically you're going to be estimating future growth rates for free cash flow. So we're in Facebook again, and here's the free cash flow per share for Facebook. And I'm actually just going to copy this, and I'm going to head over to the spreadsheet, and I'm going to paste it inside the spreadsheet. So what we want to do is we want to know the annual growth rate of this series of numbers of free cash flow per share that we're looking at. So typically what we could do is we could put equals this number here divided by this number here and subtract 1, which would give us 135%. So from 17 cents per share to 40 cents per share, I'm just going to turn these into dollars. That's a 135% increase. Okay, you could also do this exact same thing by going this number minus this number divided by the first number. It'll give you the same thing. And if we take this, doesn't matter which one, when we drag it across, we'll be finding the growth rate from each year to the next. So I'm just going to remove this line here, so we're just looking at one line, but either way is fine. Now, this is the mistake that you want to avoid. If you were to try to figure out what the 3-year average annual growth rate is, doing an average of these, that would be wrong. So if you were to drag this out like this and say, okay, the 3-year average growth rate is this, for example, or if you were doing 5 years and you took the last 5 years of growth rates and did an average of them and did this like this and said, on average for the past 5 years, free cash flow has been growing at 26.89% per year as far as a 5-year average goes, this would be the incorrect way of doing it. All right, so now we're going to do it the correct way with the compound annual growth rate formula. And so what we'll do, and by the way, this first year will be the same as what we already have here, but once we get into the 2 or 3 or 4 or 5 or 10-year annualized growth rates, you're going to see what the difference is between doing it this way that I'm about to show you and just taking an average of the annual growth rates. So if we do equals bracket this number divided by this number, close bracket, to the power of bracket 1 divided by 1 in this case, since it's actually just 1 year that we're doing, minus 1. And I'm going to turn this into a percentage. So again, these numbers match up. And if we drag this across like this, then again, these numbers are going to match up with this row, and this row are going to be the same, although we've used a different formula. So this is the formula we've used here, which works when it's 1 year. And this is the formula we used here, which is the actual compound annual growth rate formula. So now let's do our 3-year annualized growth rates. And you're going to see how what we're about to produce is going to be different than what we produce when we use this method of just taking the average of these 3 years. So if we say equals bracket, take this number here divided by the earlier number, And the reason we're doing this is because this is 3 years. So although this is the 4th year, this is 1, 2, 3. So there's 3 jumps. Now we're going to take this and we're going to do to the power of bracket 1 divided by 3, close bracket, minus 1. And then we're going to also change this into a percentage. And so what we can see is that the 3-year annualized growth rate of free cash flow per share is 88% per year. And to illustrate what I mean by that, if we took 17 cents and we increased it by 88% per year for 3 years, it would look like this. We would say 0.17 multiplied by 1 plus our growth rate to the power of 3 years. And here we have the $1.14 that we have right here. So if we increase that 17 cents by 88% per year for 3 years, that's how we get to $1.14. So you can see obviously how massive a difference this is to this. So if you were under the impression that taking an average growth rate based on what we did earlier meant that the 3-year average growth rate was 200%, then you could potentially be way overestimating future growth rates. So this compound annual growth rate formula is the one you want to be using. And if we drag this out like this, we can see that as of most recently, the 3-year annualized growth rates for the free cash flow per share is closer to 11.4% rather than what we'd be getting over here saying it's 13%. And we can do the same thing for the 5-year annualized growth rate as well. So if we do equals bracket this number here divided by this number here to the power of 1 divided by 5 in this case, because there's 5 jumps. 1, 2, 3, 4, 5. Close bracket, minus 1. I'll just turn that into a percentage. So the 5-year annualized growth rate of free cash flow is now looking like this. Now, if we did the 10-year average annualized growth rate of free cash flow per share, it would just look like this. We would say equals bracket this number here divided by this number back here to the power of bracket 1 divided by 10 in this case, because again, there's 10 jumps. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Minus 1, enter, and we'll change that to a percentage. So basically, 17 cents growing at 47.31% per year would get you to $8.18 of free cash flow per share. So obviously this column right here is what's going to be most important to us because that's going to be the most recent that we're looking at. But again, we can see that it's quite different amongst these. From last year to this year, free cash flow per share has only grown by 10.84%. And if we're only looking at how the free cash flow per share has grown from last year to this year, then that's going to limit us in understanding the actual rate at which the free cash flow per share is really growing at. But then if we look at the 10-year growth rates for free cash flow per share, 47% is pushing it. That would be way too over-optimistic to think that for the next 10 years, it'll also grow by another 47% per year. So what you could do is you could take an average of these numbers if you wanted, where you're taking an average like this and saying, you know what, maybe 23% annual growth rate moving forward for the next 10 years, for example, is reasonable. You could do something like that. Okay, so now by the way, this free cash flow per share was actually from December 2020. We didn't grab the trailing 12-month column. And if we did, then that would be $11.14. So if we take that number and we plop it in here, from there what we can do is we could highlight these numbers here and drag it over so we've got the same calculations happening that we've just done over here, but now over here. So we can see that these have appropriately used the correct periods, and this is an average of these numbers. Now, this also is going to be a little bit skewed because this was from December 2020, whereas while each of these has been 1 year, from here to here has only been 2 quarters, so that's going to mess up these numbers right here as well. If I were to be estimating Facebook's free cash flow per share growth rates moving forward for the next 10 years, for example, I would want to be very conservative. So I would not use something like this 31%. nor would I even use this 23%. I would probably use something like 15%. And I would also do my intrinsic value calculations as if the growth rate was 10% as well, just to see what that would look like if that ends up being the reality of how Facebook's growth rate turns out. Alright, so now I'm going to show you another cool way of figuring out what the growth rate will be going into the future. By the way, I want to give a quick shout out to Sam and Chris. They have a YouTube channel where they talk about investing in stocks and valuing stocks, and it's from their YouTube channel that I first saw this way of estimating future growth rates. So basically what we're going to be doing is we're going to be highlighting these numbers, and we're going to be inserting a chart. The type of chart we're going to put in as a scattered chart. Now what we can do is in the customize, under the series section, we can add a trend line, and we can change it to an exponential trend line. And then we can add a label, which is the equation for the trend line growth rate. What we can see here is this 0.269. That is the growth rate. So in other words, 26.9% is the equation for this exponential growth rate line. So this is a good way to visualize it and also have Google Sheets figure out what the growth rate is of a past series of numbers. All right, so from here, if we're gonna value Facebook and figure out what the IRR of buying Facebook right now is, we could do a simple quick valuation, and we could say that instead of using 26 or 27%, which this is predicting, and instead of using 23%, let's use actually just 18%. And so we'll say if 11.14 is the free cash flow per share right now, if we said 11.14 multiplied by, say it grows by 18%, that would mean a year from now we'd have $13.15 for free cash flow per share. And if we were to continue growing it by 18% for the next 10 years or so, and then we'll just say that we sell Facebook for 15 times free cash flow in year 10. So we'll just say this number times 15 times free cash flow. So these are our cash flows. I'm just gonna add this together. And I'm gonna do this whole thing here, because what I wanna do is I wanna use our IRR formula. So if we find out what Facebook's trading for right now, we can see that Facebook's trading for $362.65. So I'm gonna just grab that, and I'm gonna put that number right here, but with a minus sign. And then I'm gonna use the IRR formula and highlight all of this information and hit enter. And so what this is saying is that if we bought Facebook at its current price of $362.65, and if our free cash flow per share continues to grow by 18% per year, and then in the 10th year we sell the business for 15 times free cash flow, then this would be an investment that gives us a 14% annual rate of return on our investment. And so how accurate is that? Well, we could definitely get much more into the weeds than we have in this video. For example, sometimes the base year free cash flow per share can be overinflated by random swings and changes in working capital, which affect the operating cash flow line, which the free cash flow per share ultimately comes from. And so sometimes swings in change in working capital can make this number overinflated. We would have to look into that. And then there's a question about our 18% growth rate. And also typically I like to project free cash flow into perpetuity rather than just slapping on a 15 times free cash flow multiple and saying that we're gonna sell our shares for that amount. So this definitely isn't entirely complete. However, if you were to do this with a series of like 100 different companies, for example, you would very clearly start to see which ones were the better investments and which ones weren't. There would be some that give you an IRR of negative 5%, for example, or 2% or 4% or 5%, where even with the most conservative estimates for future growth, it's just not a good investment. And so those ones you'll want to completely avoid. But there will be ones where even using conservative estimates for future cash flow growth, you're gonna have a decent IRR number produced here when you use the IRR calculation, and you're gonna be able to find some good investments that way. Essentially what the IRR formula is, it's a way for, instead of plugging in a random discount rate and calculating what a stock's worth at that discount rate, instead you plug in what the stock is currently trading at, and the IRR formula tells you what discount rate at which that's a fair price. So like this video, comment below, and check out this video next. Thanks for watching to the end. I really appreciate you. Have a great day.